Greetings, dear friends. I thought I'll prepare some content on ratio analysis. I put this together primarily to give us a context. It's a simple theme, so there's no need to complicate things that are simple. So I'll start with the most simplest of examples. So I put for us what I called as A. A happens to be a business, say a given company, who's earned a profit of say 10,000 rupees, right? And B has earned a profit of 50,000 rupees. That's what we saw. Now, we also can see in this example that A has invested 1 lakh rupees as capital and B has invested 50,000, 50 lakhs as capital. I repeat, A has invested 1 lakh as capital. So, who has been more efficient in earning profits according to you? How do we understand this, right? What's the right way to understand what's the profit that A has earned and what's the profit that B has earned? For which we need to go to the next slide. If you go to the next slide along with me, you will understand that all that we got to do is to take the profits and take it to the numerator, divided by the initial capital, multiplied by 100. So we take 10,000 rupees divided by 1 lakh, multiplied by 100, that gives us 10% profit that A has achieved. If you take B, B has attained how much profit? So we take a simple formula. We take the profit that B has earned, which is 50,000 rupees, divided by 50 lakhs, and then we multiply that by 100. So basically, we're talking about 1%. It should be obvious from this example that a single figure taken from some kind of a financial statement of a business can mislead you about its performance. One figure should be compared with another to get some meaningful understanding of financial statements. This is what is called ratio analysis. Ratio analysis is nothing else but it is a statistical yardstick by means of which the relationship between two figures can be compared and measured. So the ratio analysis of financial statements in particular refer to the process of presenting and determining the relationship of different items or groups of items which are analyzed from financial statements. What is the purpose of ratio analysis? Basically, what we saw here in this slide is ratios. So we say A making a profit of 10%, B making a profit of 1%. The purpose is to have an in-depth understanding of various aspects of the business. Generally, I've listed down 5 of them that we need to look at. These are various aspects for which ratio analysis is normally prepared. Statistical yardstick, you already heard about that. Second, liquidity. What is liquidity actually? All that liquidity means is that we need liquidity in the business to meet short-term financial strength. So liquidity only stands for short-term financial strength. Next, solvency. What does solvency mean? It means we need to take into consideration the long-term financial strength of the business. Next, profitability. What does profitability mean? It means the ability to earn profits in future. And lastly, operational efficiency. What does operational efficiency mean? The efficiency with which the business is managed is called as operational efficiency. I repeat once more. It's simple, it's very simple. The efficiency with which the business is managed is called as operational efficiency. So for the purpose of this analysis as well as what we're talking about, I've put together a balance sheet on the next slide which we'll try and group into 4 categories. This is what a balance sheet really is. On the left side, we have what we call as credit. What are the credit items or receipts? Or for whom are these items? It also means liabilities, which means to whom is that going to be paid for or to whom does it belong? These are words that we use for the credit side of the balance sheet. The debit side of the balance sheet stands for debits, which means it stands for payments, which means it tells us how money and things related to money are utilized. It also tells us what our assets are. It also tells us what are available. And if you quickly read, you'll understand that under the category A, under fixed liabilities, I've put equity share capital, reserves, funds and profits, preference share capital, long-term loans and deposits, mortgage loans, etc. On the B side, which is the debit side of the balance sheet, we have fixed assets. Under fixed assets, it's very simple to understand, right? We have land and machinery, we have plant, buildings, machinery, fixtures, fittings, freehold property, leasehold property, furniture, vehicles, goodwill, copyright, trademarks, losses, long-term investments. Under current liabilities, we have bank loans, we have bank overdraft, we have bills payable, which is on the credit side of the balance sheet. Current liabilities falls on the credit side of the balance sheet. So what are they? We have bank loans, bank overdraft, bills payable, sundry creditors, short-term loans, outstanding receipts, pre-receipt incomes, etc. On the current assets, or rather the debit side of the balance sheet, we have cash in hand, we have bank balance, we have bills receivable, we have sundry debtors, we have short-term investments, we have closing stock, we have outstanding incomes, prepaid expenses, etc. So when we're talking about fixed liabilities, which is what category A is, what are we talking about? We are talking about amounts received on a long-term basis. The period generally being more than 1 year. Very important to understand. Next, when we talk about fixed assets, which is the debit side of the balance sheet, what are we saying? We are saying fixed assets are acquired by making payments which are expected to be kept in the business on a long-term basis. Category C, which is current liabilities, it refers to amounts received on a short-term basis. The liabilities should be discharged, remember, within a year, which is why we call them as current liabilities. Category D, which is current assets, are payments made on a short-term basis, which can be realized within the operating period or within 1 year. So taking this as the background, let's try and understand how this will look in a financial statement of a given company, especially with ratios related to, say, liquidity, solvency, profitability, operational efficiency, and try and interpret the significance of these ratios. But for the example today that I have, I'll probably just look at one of them just to ensure that we all understand what we're talking about. So I'll try and spend time only on what we call as the current ratio or working capital ratio. Current ratio or working capital ratio is a concept that means one and the same. So basically current ratio and working capital ratio means one and the same. Remember that this is a liquidity ratio. So when we say liquidity ratio, we're talking about short-term financial strength of a company. So I've taken an example here. What does this example talk to us about? It talks to us about a company where we have again the credit receipts and from whom on the credit side of the balance sheet, which is on the left side as you see in the screen, and then the debits payments, how it was utilized, or assets where what are available on the right side or the debit side of the balance sheet. And we see a concept there called fixed liabilities and current liabilities. Fixed liabilities is 9,500 rupees and current liabilities is 500 rupees. Fixed assets is 9,000 rupees and current assets is 1,000 rupees. The total of the left side and the right side of the balance sheet happens to be 10,000 rupees, as you can clearly see. So I wanted us to go through this example to understand the concept of ratio analysis and what we are looking at. Just above this balance sheet, you will see that the current ratio means that we are comparing current assets with current liabilities. So when we do this comparison, what are we talking about, right? Which is what I want to cover on the next slide. So current ratio in percentage is nothing else but your current assets, which is 1000 rupees, divided by 500 rupees, which is current liability, multiplied by 100. So this gives us 200% current ratio in proportion. So this is not ratio but ratio in proportion. I just corrected it again. So current ratio in proportion is equal to current assets, which is 1000 rupees divided by 500 rupees. What does this tell us? It tells us that the current ratio is 2:1. What is the current ratio in times? It's again current assets by current liabilities, which tells us that it's 2 times. So I just want us to think about the simple example. Depending on the situation, what we have to understand is that ratios may be expressed in any one of these forms. So there is no hard or fast rule about it. What's most important to understand is when is percentage used? The percentage mode is advised. Here in this case, when the numerator, 1000 rupees in our example, is lesser than the denominator, which is 500 rupees. So converting the resulting fraction into a percentage makes it easier for understanding. Hence, a percentage results in a full figure. So in this context, we know it's 200%. When is proportion used? Proportion mode may be referred or preferred when the numerator is greater than the denominator, since the result will be in full figures. So in this case, the proportion is 2:1. When is times used? Times mode is used when the numerator is generally more than 5 times the denominator normally. But here in this example, the ratio is 2 times. So apparently, financial analyst tells us that the ideal ratio, when we're talking about current ratio, the ideal ratio is an average of the ratio worked out for several companies of similar nature, business and magnitude. So the ideal current ratio is 2:1. So how do we look at this? And how do we go about interpreting it? We know what the ideal current ratio is, which is supposed to be 2:1. But how do we interpret it, right? Current ratio, what does it express? It expresses the ability of a business to meet its short-term obligations. Within the normal operating cycle, which is normally a period of 1 year, the current assets are converted into cash to discharge current liabilities. That's the purpose. So in our example, the current assets being twice the current liabilities, we saw that, right? It was 2:1, which means 2 times. So in our example, let me go back to it again. The current assets being twice the current liabilities, we have to understand that the margin of safety is adequate. Suppose current liabilities are more than current assets, then it's a case of inadequacy, which means the eventuality may arise when short-term creditors will have to be paid by disposing fixed assets, because we won't have current assets to pay those fixed assets, right? So in such a case, the firm's financial position seems to be shaky and the firm may be on the verge of liquidation, which is why we have to have the right ratio. Some of the factors which generally influence the current ratio are the speculative nature of the business, its seasonal character, the credit period required and allowed, what is the trend in the business, what kind of business environment it is. Normally, a 2:1 ratio is considered satisfactory, which is what the margin of safety means. So this allows for making up for any temporary loss as well as leaving some working capital, because we always need some working capital. So when current assets and current liabilities are equal, which is 1:1, if they're equal, it may be presumed that the short-term creditors are meeting the day-to-day requirements of the business in its entirety. Because what is current liability? If it is equal to current assets, obviously it means that short-term creditors are meeting the day-to-day requirements of the business in its entirety or in its completeness. In such circumstances, if there is any loss in the realization, if there is any loss in the realization of current assets, the short-term creditors tend to suffer. Therefore, this ratio is considered highly decisive for all short-term creditors. A very, very high current ratio, such as 4:1 or 6:1, indicates that there are too many current assets which are not properly utilized in the business. This may also mean that the management of the concern is not adopting proper investment policies for optimum utilization of its current assets. A very low current asset ratio, which means if the current ratio is a very low ratio, it indicates lack of liquidity and shortage of working capital. I want to cover the last point, which is called as window dressing. What actually happens in window dressing? To beguile investors into believing that the current ratio is more sound than it actually is. You know what some business people do? Some business concerns seek recourse to what is known as window dressing. That is, manipulation of current assets and current liabilities at the close of the accounting period. So what do? Sometimes what they do is, it may be done by an equal decrease in current assets and current liabilities. For example, by discharging a short-term loan or sundry creditors. In our example, with the current assets of 1,000 rupees and current liabilities at 500, current ratio we know is 2:1. But if the current liability is just discharged to the tune of say 250 rupees, then the ratio would change, because current liabilities will then become 750 if we discharge current liabilities to the tune of 250 rupees. Then from 1,000 rupees it will reduce to 750, right? So what will then happen? Then the ratio will change to 3:1, which means 750 rupees is to 250, which means 3:1. Because assets, you'll have to subtract 250 from 500 rupees, which is equal to 250. So 3:1, they will try and manipulate it, because an equal increase in both current assets and current liabilities, on the other hand, will reduce the current ratio. So not only do businesses show that there can be a decrease in current assets and current liabilities by discharging, say, liabilities and ensuring that the current ratio is a higher number, they will also try and increase it. To increase it, what would they do? They will reduce the current ratio. So business concerns which intend to show a better current ratio naturally avoid purchasing goods on credit just before the closing of the accounting period in order to show a better current ratio. Current ratio, apart from testing the short-term financial strength of a concern, is also employed for understanding the adequacy or otherwise of the working capital. Therefore, it is also called as working capital ratio. The working capital requirements of a concern will be less when the stock and debtors move with a greater velocity. As I come to the end of this example, I hope all these slides are pretty much clear. The objective of putting the slides together was to give us an overview of what ratio analysis is. Yes, there are other ratios like liquid ratio, which is also called as quick ratio. It's called as acid test ratio, cash ratio, and several others, which if you're interested, we can cover in the next session. I hope this is clear. Thank you for paying attention.